Hi friends, welcome to Prashant Education. Many of you asked for corporate valuation and restructuring 2020 question paper solution. That's why I'm giving this, and this I will be not doing it in Kannada. Why? Because few of the students told me that they don't understand Kannada. That's it. This one I'm doing it in English so that it will be helpful for all. Okay, come, let's go to the question. Okay, let's look at the questions. Mondavi Limited reports a profit of 100.32 lakhs after 34% tax for the financial year 2018. An analysis of the account reveals that the income included extraordinary item of 14 lakhs and extraordinary loss of 5 lakhs. The existing operation expects for an extraordinary item are expected to continue in future. Further, a new product is launched and the expectation are as under. So sales is 70 lakhs, material cost 20 lakhs, labor cost 16 lakhs, fixed cost 10 lakhs. From the above given information, compute the value of business given the capitalization rate applicable to such business in the market is 15%. So what they are asking us, first they are asking us to value the business. So we need to give a number. Value means the how much that company is worth. We have to give that value. Okay. This is in two parts. Okay, what is this is one part. Okay, and this is another part of a new product launch. So this and this, first we will do this part and then we will do this part. Okay, so let's first look at profit before tax. Here they are telling this is profit after 34% tax. So we need to add back the tax. So 100.32 divided by 1 minus 0.34, so 152 lakhs. So 152 lakhs was the profit before tax. From that they have removed the tax of 34% and they are telling 100.32. Now I have added tax back to this number. Okay, next. So extraordinary income, you need to less extraordinary income, which is 14 lakhs, then add extraordinary losses, which is 5 lakhs. Now, if you total everything together, 152 minus 14 plus 5, it will come to 143. So this one we have done. This we did. Now we are going to calculate on these things, new product, which is there. Profit from new product, sales is 70 lakhs, less material cost 20 lakhs, less labor cost 16 lakhs, fixed cost 10 lakhs. So 2, 3, 4, 46 lakhs is the total uh, cost. So if you remove from sales, if you remove the cost, you will get 24 lakhs. So we have 143 lakhs and 24 lakhs. Um, so they are telling us to compute the value of business. So profit before tax, if you add both together, 143, this one and this one, 143 plus 24, you will get 167 lakhs. Less tax at 30%, that comes to around 56.78. So minus 167 minus 56.78 will give you profit after tax of 110.22. But they have given the capitalization factor, so we need to discount this to divide this by the capitalization factor. So the value of business is 110.22 divided by 0.5, which comes to 734.8. So this is the value of business. Okay. Okay, let's go to the next problem. Let's look at the next problem. The key financial parameter of Veer Limited are follows: profit after tax 25 crores, book value of assets 60 crores, sales 135 crores. The valuation officer feels that 50% weightage should be given to earnings in the valuation process. Sales and book value may be given equal weightage. Okay, the valuation officer has identified three companies which are comparable to operations of Veer Limited. So he has given three companies and we have a profit after tax, book value of assets, sales and market value. Find the value of Veer Limited using comparable company approach. So they are telling us to com do evaluate Veer by comparable company approach, and he is telling that these three companies have the same operation that as Veer. So let's get into the problem. So they have given us profit after tax, book value of assets, sales and market value. First we will calculate ratios. Okay, what ratios I am talking about? It is market value by sales. So market value by sales is 115 by 95. 115 by 95, 1.21 you will get. Then you have 145 by 105, 1.38, 220 by 135, 1.68. So we will average it out. Okay, so the average for market value divided by sales ratio is 1.40. Similarly, we do it for market value and earning ratio. Okay, and similarly we do it for book value ratio. So now we have got all the ratios. Okay, we will use these ratios and we will calculate the value of Veer Limited. So for Veer Limited, they have given us profit after tax 25 crores, book value of asset 60 crores, sales 135. So if you multiply this, okay, so market value 1.40 into 135, the value is 189. Market value per earning 7.86 into 25 is 192. 281.60 is 168, 8.6. So we got all the values. Now we need to give 50% weightage to earning, and rest we will give 25%. Okay, so the valuation officer feel that 50% weightage should be given to earning in the valuation process. So for this earning, okay, market valued by earning ratio, we will give 50% weightage, and the other two we will give 25%. See, this is how we calculate this. 189, we know 189 into 0.25. Why I am giving 0.25? We are giving 25% weightage. Okay, they have told us to give 50% weightage to earnings, so 25% will go to sales, and book 25% will go to book value ratio. So 192 into 0.5, 168 point into 0.25 total. So the value of firm is 185.4 crores. Okay, let's go to the next problem. Okay, let's look at the problem. EVA, definitely they will give one problem on EVA, so you need to know how to calculate an EVA. The balance sheet of International Computer Limited at the end of 2016 is given below. So this is the balance sheet. Okay, and also they have given the income statement, and also they are telling ICL equity has a beta of 0.9, the risk-free rate of return is 6%, and market risk premium is 6%. The interest rate of ICL debt is 8%. The tax rate for ICL is 35%. What is the EVA for 2019? They are asking. So for 2019, they have given us balance sheet and income statement. So we need to calculate EVA. So first of all, we will define what EVA is. EVA is nothing but economic value added. How do you calculate? It is equal to NOPAT minus WACC is weighted average cost of capital into capital employed. Okay. So in this, first let's calculate NOPAT, then we will calculate weighted average cost of capital, which is also called as WACC. Then capital employed is already there. So first we will calculate net operating profit after tax. So we know sales. Okay, so revenue they have told 90 minus less cost of goods sold 50. So gross profit is 90 less operating expenses. So they have given 16. So if you remove operating expense from gross profit, we are going to get operation profit EBIT. But we need net operating after tax, so we need to take tax somewhere they have given, yeah, 35% they have given here. So 35%, 24 into 35, 8.4. if you remove, so net operating profit is 15.6. so NOPAT we got. Now we will calculate weighted average cost of capital. So determination of weighted average cost of capital, usual formula is this: E divided by E plus D. E for equity, D for debt. KE is cost of equity, then KD is cost of debt. Let's look at whether they have given any information to calculate KE. Okay, so if you look at here, they have given beta, they have given risk-free rate, they have given, and risk premium they have given. So we can use CAPM, capital asset pricing model, in order to determine cost of equity. So capital asset pricing model, CAPM model, is KE is equal to RF plus beta into RM minus RF. So this RF is risk-free rate of return, beta and RM minus RF is, this is risk premium. Both together is called risk premium. Okay, so RF they have given 6% and the risk premium 6%, and beta also they have given 0.9%. Substituting into that, we will get 11.4%. And always remember KD, cost of debt. Okay, so cost of debt, you need they have given 8%, you need to remove tax from it. Okay, so we will substitute the values here. E we have it here 50 equity, 50 debt, so total will be 100. So 50 divided by 50, 50 divided by 50 plus 50 into 11.4 plus 50 by 50 plus 50 into 8 into, we are removing the tax. So we got weighted average cost of capital as 0.5 into 11.4 plus 0.5 into 0.58. So it comes to 8.3%. So this is 8.3%. Okay, now let's put it in our EVA. No part we have got 15.6 and we have got our weighted average cost of capital 8.3% into capital employed is 50 plus 50 is 100. So if you remove you are going to get an EVA if 15.6 minus 8.3, so the EVA is 7.3. So 7.3, this is in terms of crores. Yeah, it will be in terms of crores. So the answer is 7.3 crores. Okay, let's go to the next problem. So two firms, A and B, operating in cement industry, both the firm are planning for a merger. Firm A is worth 200 lakhs and B is worth 50 lakhs. On merger, the two would allow cost savings with a present value of 25 lakhs, assuming that A by B is for a cash of 65 lakhs. Estimate value of combined firm, the cost of merger for firm A, NPV to B holder, NPV to A shareholder. Okay, let's let the value of combined firm represented as PVAB and the value of two separate firms are PVA, PVB. Okay, so gain is the difference between the value of combined firm and the sum of the values of two individual firm. It is given as, so gain is PVAB minus PVA plus PVB. From this, we are going to calculate value of combined firm. So gain they have given us PA they have given 200 lakhs, PB they have given 50 lakhs, and gain they have given as 25 lakhs. So present value is 25 lakhs they are telling. Substitute these values here in this formula. 25 is equal to PVAB minus 200 plus 50. So if 250, this is minus, here it will be minus 250. If you take it to this side, it will become plus 250 plus 25, 275 lakhs. So the value of combined firm is 275 lakhs. Now let's calculate cost of merger. So cost of merger is cash paid minus PB. So cash paid is 65 lakhs. Okay, and B worth is 50 lakhs. So 65 minus 50 is 15 lakhs. Okay, next NPV of B shoulders is the gain of B shoulder is the cost of the firm 15 lakhs. This means out of 25 lakhs gain, firm B has captured 15 lakhs. Next, NPV of A shareholders is equal to overall gain on the merger less the part of gain captured by B shareholders. So 25 minus 15, 10 lakhs. So NPV of A shareholder is 10 lakhs. Okay, let's go to the next problem. The current dividend of equity of NSB Limited is 5. The dividend is expected to grow 18% annual rate for 5 years, then at 12 rate for next 3 years, after which it is expected to grow at a 6% rate forever. If the required rate of return is 16%, what is the intrinsic value of share? This is a 3-stage growth model problem. Okay, you have a big formula for it. Don't do it formula wise. Follow my method. It's same as that of your formula. You will get the answers will be same. Okay, so first step what we will do is the dividend stream during the first 5 year of NCB will enjoy a relative high growth rate of 18% and then 12% for the next 3 years. Okay, so first we will calculate the dividend for um, 5 years, and then we will calculate it for the next 3 years. So for dividend for the first year, okay, dividend for the first year is 5 into 1.18 to the power of 1. Why? Because 18% they have given here. So first year it will go 1.18, next year it will go 1.18 square, next year it will go 1.18 cube, next year it will go 1.184 to the power of 4, next year it will go 1.18 to the power of 5. Next, what they are telling, next the growth rate, it decreases to 12%. So next, for the next 3 years we have to decrease it by 12%. This will remain the same. Okay, fifth year value here, either you can write the fifth year value or you can write it like this. So 1.12 to the power of 1, 1.12 to the power of 2, 1.12 to the power of 3. So if you calculate this, it will come to This is 5.9, 6.96, 8.2, 9.69, 11.44, 12.81, 14.37, 16.07. So these are the dividends which you are going to get it in future. So you need to bring it to today's value. So you know how to do that. We do NPV method. So we will put NPV method and bring all this dividend to today's value. Okay. So first we will take year. Okay, next we will take the cash flows. These are the cash flows. Then they have given if the required rate of return is 16%. So 16% we are going to calculate. So for the first year it will be 1 divided by 1.16. Next year it will be 1 divided by 1.16 square. Next year will be 1 divided by 1.16 cubes, so on. Like that we will calculate and we have written the values here. Okay. So next we will multiply the cash flows with the PV values. Okay, for example, this into this, this into this, this into this. So these are the values which we are going to get. Okay, then we will sum up all the values. Okay, sum up all these values. We will get our net present value. What is the today's value of all the dividends which we have got? So it is 41.57. So first step we have calculated the dividend. Next step what we need to calculate is, so for under after this 3 years, after 8 year, it is going to grow at 6% rate forever. So what we'll do, we will apply this constant growth model at this point. So constant growth model, this is the formula. uh, so P9 is equal to D8 into 1 plus Gn divided by R minus Gn. Already we have calculated Gn 16.01. Growth rate they have given 6%. Required rate of return is 16%. Substituting those values, we will get 170.34. Now we are going to add these two values. This no, no. What we need to do is we need to bring this to present value. So this value is in ninth year forever. We have to get it to present value. So we will divide it by either you can multiply it by 0.305, or else what you can do is you can divide it by uh, 1.16 to the power of 8. Either you can divide or you can multiply with this. So it will come to 51.95. Now add this and this, that will be your value. So this is the price. So we are doing it in 3 steps. First step, uh, 2 step for the 3 step. First step is dividend. We need to calculate, bring it to today's price. Then constant growth model, bring it to today's price. Then add both of it. Okay, let's go to the next problem. Alpha Corporation plans to acquire Beta Corporation. The following information is available: total earnings, number of outstanding shares, market price per share. Alpha company, Beta company they have given. So what they are asking us, what is the maximum exchange ratio acceptable to the shareholders of Alpha company if the PE ratio of the combined entity is 12 and there is no synergy gain? Okay, what is the minimum exchange ratio acceptable to the shareholders of Beta Corporation if the PE ratio of the combined entity is 11 and there is a synergy benefit of 5%? Assuming that there is no synergy level, what is the P multiple will the line ER and E2 intersect? So they are asking us to find all these three. Let's take the first one. So these are the things which they have given: S1, S2, 20 million and 10 million outstanding shares. Then earnings they have given 50 million, 20 million. Then they have given us the market price, PE, P1, P2 they have given. Then they have given us a PE ratio, PE1 to synergy they have given it as 12. Okay, let's, the maximum exchange ratio acceptable share combined is ER1 is equal to minus S1 divided by S2 plus PE1 to E1 plus E2 divided by P1 S1. So substitute all the values. So minus 20 divided by 10, 12, 50 plus 20 divided by 30 into 10. So you're going to get 0.8. So 0.8 is the answer. Let's go to the next one. Next one is the minimum exchange ratio. Maximum is done. Minimum exchange ratio is given by ER2 is equal to P2 S1 divided by PE1 to E1 plus E2 minus P2 S2. Okay, substitute all the values. So 20 into 20 divided by 11 into 1.05. So here you need to know what they are telling. There is a synergy benefit of 5%. So that 5% I have added to 1. Okay, so I have made it as 1.05. 11 they have given. We need to have the synergy benefit will be 5%. Either you can do this way or take 11, calculate 5% for this, 5% for this, then add it to 11%, or else you can do 11 into 1.05, which will grow that 11% to 5% more. 100% is 11, so 5% more it will grow if you multiply with 1.05. So you will get the answer of 0.657. Okay. Let's look at the next one. Assuming there is no synergy level, you can do it in two ways. Previous videos I have shown you how to do. Now I will show you how to do it in a formula way, easy way of doing things. Okay. So assuming that there is no synergy level between line ER1 and ER2 will intersect at weighted average of the two prices earning multiple, wherein the weight corresponds to the respective earnings of the two firms. So what they are telling is, so um, uh, this is where it will intersect, they are telling. So this 50 million is nothing but this 50 million plus 20 million is nothing but this 20 million. So both added together you will get 70 million. We need to find PE1 and PE2. So PE1, we will take this 30 market price into 20 divided by 50, we will get PE1. Similarly, we will take this 20 multiply with 10 million and divide it by 20 million, we will get 10. Okay, so this 30 into 20 divided by 50, 20 into 10 divided by 20. So substituting the values, we will get 11.43 is the place where it will intersect. Both ER1 and ER2 will intersect. Okay, let's go to the next problem. Okay, this is the case study problem. Uh, because it is big, you will think it is very difficult to do. No, nothing is there, but you need to understand few things here. Then we will go ahead and solve this problem. So Samudra Industry deals in production and sales of consumer durables. It is expected sales revenue for the next 8 years in the million are given in the table. Condensed balance sheet of March. Okay, this is this sales revenue they are given. This is the sales revenue they are given. This is the balance sheet they are given. Few points additional information here. Its variable expenses will amount to 40% of sale revenue. Fixed cash operation costs are estimated to be 60 million per year for the first 4 years and 20 million for year 5 and 8. In addition, an extensive advertisement campaign will be launched requiring annual outlay as year for year 1 it is 5, second and third year it is 15, fourth and sixth year it is fourth, fifth, sixth is 30, 7, 8 is 10. Long-term assets are subjected to depreciation on straight line method. So they have given a straight line method. We can calculate depreciation based on this. Next, they are planning capital expenditure. Assumed to have incurred in the beginning of each year for the next 8 years. Capital expenditure they have given. Working capital investment they have given. Given the tax benefit of Samudra, the efficient tax rate estimated is 30%. The cost of equity capital is estimated at 16%. The free cash flow for the firm is expected to go at 5% per annum for 8 years. Determine discounted cash flow value of firm and equity. Okay. So first we need what we need to calculate. We need to calculate discounted cash flows. First we will. Okay, friends, let's solve this problem. Okay, so what we will do is we will solve this in 4-step or 5-step mode. The first step will be determination of weighted average cost of capital. Why that is necessary? Why? Because we need a discounting factor. So cost of capital. So we have to determine first weighted average cost of capital. Then what we'll do, we will determine the depreciation. Why? Because it will be useful for us when we are doing our cash flow statements. So in order to arrive at our free cash flows, we need to have depreciation. Then we will calculate, determine investment, current asset, whether we need any investment or not, that we will determine. That will be our third step. Then we will calculate the present value for the explicit period. So they have given us the sales revenue and all. Using that, we can calculate present values of explicit period projection. Next, we will determine the present value in respect to continuing value. Then we will solve the problem. Okay. First, let's go ahead and calculate determination of weighted average cost of capital. So in order to determine weighted average cost of capital, these are the things which are available with us. So we have 12% debt. Then they are telling cost of equity capital is estimated at 16% and the tax rate they have given. Okay, using this information we can calculate, and also they have given 120 in equity and 80 in debt. So we know how much is in equity fund, how much is in debt fund, so we can calculate weighted average cost of capital. There are many different ways you can use any of the method to calculate your weighted average cost of capital. For example, I've used this method to calculate. I know my percentage cost, they have given 16% equity, then 12% debt. So I need to remove tax from it. 12 minus 1 minus 0.3 is 8.4. Then either you can use this or you can use your weights percentage also to calculate. For example, here I have taken 120. Why? Because this is equity we have invested 120 divided by both equity and debt. So equity and debt together is 200. Similarly for this, 80 divided by 200. So if you reduce this, if you do any one of the calculation is more than enough. 2 3s are 2 5s are, so 3 by 5, 0.6. Okay, if this is 0.6, definitely this will be 0.4. You don't have to do any calculation. Why? Because both together should lead to 1. So 0.6, if you add 4, it will lead to 1. So multiply 16 into 0.6, 8.4 into 0.4, you are going to get 9.60, 3.36. Add both together, 12.96, which is approximately equal to 13%. Here I have not taken the percentage. So if you are not taking, this will be in percentage. If this you are taking as percentage, for example, 16 is 0.16, then this is 0.084, then this will come to around 0.1296. Okay, then you need to take the percentage. This I have not done, so no need to do this. I've taken percentage as it is and we have calculated. So our weighted average cost of capital is 13%. So first step is done. Next we have to determine the depreciation. So in order to determine the depreciation, they have given us what method we have to follow. We need to follow straight line method. Okay, so I have taken long-term asset, they have given 170. So 170 divided by 8. Why? Because straight line method 21.25. So 21.25 from here to here, it's 21.25 minus. But here I have written it as 26. Why? Because additional capital investment is going on, even that we have to consider in our depreciation. So capital expenditure we have to consider in our depreciation. That's why I have written capital expenditure here. So I know every year is 21.25. Add 21.25 to this, it will become 26.25. Again, if you come to the next one, 170 minus 21.25 is 148.75. Again here 21.25, add it to 8. Okay, you are going to get 29.25. Similarly here 21.25. In order for you to show I'm writing this, so it will 41.25, again 21.25, and so on. So we calculated our depreciation. So we have our depreciation in place. Okay. So understood how to do the depreciation. If they have given any percentage, okay, for example, if they have 15% every year, then you need to add 170 plus 5 we need to add and take percentage of it. Okay. Okay, so depreciation is done. Now we are going to calculate investment, capital expenditure plus current asset. Okay, now we will determine the investment, capital expenditure plus current asset. So year 1 2 3 4 5 6 7 8. So investment required, capital expenditure plus current asset total. Why? Because current asset they are told is estimated 20% of the sales revenue they are telling. Okay, and also in the balance sheet they have given us the current asset is 30. So according to whatever they have given, if you take sales revenue 80% into 20%, so the total is 21. 5 plus 16 is 21. Existing investment in a capital asset, sorry, current asset is 30. They have given it here in the balance sheet. So we will take 30. So 21, 30. 30 is already there. Only 21 is required. So no additional investment is required. This will be nil or zero. Okay, understood the first one. Okay, next let's go for the second year. Second year, we know capital expenditure is 8, and here 100 is there. 20% of 100 is 20, 28. Now for the existing investment in CA in year 1 will be 30 minus 5. Okay, 30 minus 5, that will be 25. Okay, so 28 and 25, the difference is we need to add 3 to existing investment in order to bring it to 28. So we need to have an additional investment of 3. Okay, next year 20, 30, 50. Okay, and the existing investment will be 28 minus 8, that will be 20. Okay, so 20, 50, again 30 investment we have to do. If we found this, then it will be very easy. Just write this first in the existing. If you have current asset minus your capital expenditure, it will be 25. From here onwards, take whatever value here the current asset is giving. No, that value you note down. That's more than enough. So next year will be 25. 44 will be 69. Now we will take this value and write it here 30 in order if you don't understand this 30. So 69, 30. Again, 39 is required. 39 is required. We need to put 39 there. Okay, next we will come 35 and 60. So this is 39, sorry, 39. Okay, next 35, 60, 95. Again 44, we will write it here. Okay, so 95 minus 44, 51. Similarly for the sixth year, 60 we will write it there, and 77 minus 60 is 17. Again seventh year, we will write 52 here. 52 61 minus 52, 9. Last year 46, 4. So we calculated the additional investment which is required in the investment. Okay, next let us calculate the cash flows now. Now let's determine the present value for the explicit period, meaning we are going to calculate the cash flows. So let's first write the year 1, 2, 3, 4, 5, 6, 7, 8 years. Then we have sales 80, 100, 150, 220, 300, 260, 230, 200, less variable cost, that is 40% of the revenue which they have provided. So we take this 80 into 0.4. 0.4 will be 32. Similarly, we will calculate for each one of them. Okay, so variable cost we came. Now the fixed operating cost which they have given 16, 16, 16, 20, 20, 20. Then we have advertisement and depreciation. Okay, so everything we remove from this 80, 100, 150, 200. We add all this and remove it from this, add all this, remove it from this. You are going to get your EBIT, earning before interest and tax. If negative sign is there, don't worry. Okay, now let's calculate tax for this. Tax is 30%, 0.3. So we are going to get net operating profit after tax. Okay, now for this we will add back our depreciation. Why? Because always depreciation is considered as a cash inflow, it's not an outflow. So we will add back depreciation, so we will get gross cash flows. From this cash flows we need to remove any investment which we have made. We already calculated the investment in capital assets. Okay, so first year it is nil, next year 3, 30, 39, 51, 17, 9, 4 we have calculated there. So if you remove capital asset less investment in capital from the gross cash flow, you will get free cash flow. So free cash flow we have found out. Now we need to have a PV factor of 13%, which we have already calculated. This 30% is nothing but weighted average cost of capital, which we have which we calculated. So for the first year it will be 1 divided by 1.13. For the second year it will be 1 divided by 1.13 square, 1 divided by 1.13 to the
cube. If you are doing it in the calculator, just divide it by 1.13. Okay, first do 1 divided by 1.13. This value will come. 3-digit value you take. Again, this divided by 1.13 you do. This will come. This divided by 1.13 you do 0.693. Every time divided by 1.13 till here you will get the numbers. 3-digit numbers you have to take. Usually we will take 3-digit number. We need to take the 3-digit number. Then we will multiply this with this to 26.775 into 0.885, 25.925 into 0.783, 23.675 into 0.693. We will multiply and we are going to get PV. Okay, so total PV we have calculated, and so PV we have calculated. Now we have to total all this, sum it up. Okay, sum it up. So your total PV will be 205.58. Okay, now we calculated for explicit period. Now continuing value. So even after 8th year, that company will be growing. Okay, that growth rate and all they have given. We will use that and we will calculate our uh, now we will determine the present value in continuing value, in the present value in respect to continuing value. For that, the formula is, usually this is in the 8th year, right? After 8 years, you do free cash flow after 8 year into 1 plus G divided by KE minus G. Don't confuse KE for cost of equity. It will be weighted average cost of capital that we are going to take here. Okay, so if you put all the values, so free cash flow at the 8th year is 68.37. Growth rate at the end they have given 0.05, and weighted average cost of capital 0.13, again growth rate. So 897.422 is the continuing value. But this we have to bring it today. Why? Because this is after 8 years which we are going to get. So today we have to bring this value to today. So we will divide it by 1.13 to the power of 8. It will be 337.5741. Okay, now we got the continuing value as well. Now we will total value of the firm based on discount cash flow output of free cash flows is PV of free cash flow during explicit period, which we calculated 205.58, plus PV of cash flow after explicit period, that is continuing value, which we have calculated here 337.57. Add both together, total value is 543.15. So they have told us to calculate total value and also value of equity. So for value of equity, we know total value of the firm is 543.15. Remove debt from it. Okay, so you need to remove only debt from whatever 543.1. So debt is 80. So if you remove that, this will be the value of equity. This is how you are going to solve this problem. Uh, Split it into stages so that you will be able to easily understand what we need to do. These problems are very simple. Only thing, if you know the concept very well, you can easily solve these kinds of problem. Okay, thank you guys. Okay, thank you guys. Please do subscribe to my channel, and also please tell your friends to subscribe to my channel. I will be getting more videos on question paper solution, and also if you require any question paper solution, just send me the load it to drive and send me the question paper. I will try to solve it. Okay, thank you friends.